Okay, today we're just starting to talk about the inventory. We talked about merchandise transactions last time, and then now this is the lecture for accounting for the inventory under different methods. So there's different costing methods you can use, but these are just assumptions about how you're going to assume the flow of the cost worked. It's not the actual product has to flow that way, but it's just that this is the way we're going to account for the cost. So I'll talk to you about the different methods and then you'll understand what I mean by that. There's this one, the main method that most people use, I guess most people are familiar with, is first in, first out inventory. And that would be a case where when you accumulate your cost, you assume that the one that you're selling, if items are the same product, you assume the one you're selling is the first one that you bought for and that it's in your inventory. So when you have inventory, you continually replenish it. So if it's the same item number or the same item type, even maybe even the same exact specifications with no modifications, you could have a lot of different purchases of the same goods that are being sold to your customer. So there's not really a reason you have to account for the cost in one particular way or the other. But first in, first out is the simplest because what it does is takes the earliest inventory that you bought of that type and assumes it was the first one sold. But there's also other ways you could do it, like last in, first out. Some people like to use last in, first out because it more closely aligns with what the replacement cost would be, because you're costing out the last one rather than an earlier one. So it's more realistic cost figure for the current sale. So you can see what your profits are a little bit more accurately by using last in, first out. Some people like to do that. Then other companies choose to use the weighted average method where they just average out the cost. So if they bought a lot of product, some was low price, some was high price, some was middle ground, they would just average it out and that's the cost they would attribute to the sale. The reason we need to know this is, as you remember, when we were entered into merchandising, we added the issue of perpetual recording of the transaction, perpetual inventory transactions. And so what happens is every time you record the sale, you record the cost related to it. So this issue we're talking about in this chapter is just helping us decide how much cost are we going to attribute to that sale. And so the last method, besides first in, first out, last in, first out, weighted average, is the specific identification. The only people that really use those or companies that really use those are big ticket item. So like if you sell diamonds or automobiles or maybe recreational vehicles, RVs, you would keep track of them individually. So you know how much you invested in each one. And then you would show when you made the sale, you would actually put the VIN number if it was like a motor home. Or if you've got the diamond, you would do this, you would enter the specifications for that particular diamond to decide how much it costs against the sale. And so this high dollar items are the only thing, or customization items. So when you have a product that just has a homogeneous nature and you make many copies of it, you would never use specific identification. Well, at least not at this point in time. Someday in the future, maybe whenever we have Internet of Things attached to every item that's created. But in any case, that's a different issue. But for now, specific identification is way too expensive to do with every item that you're making whenever there are multiples of the same item over and over and over. So let's see. For this chapter, we're talking about these methods. We're going to work through a lot of examples that are going to help you learn how to calculate first in, first out, last in, first out, weighted average, and then specific identification doesn't really require a learning how. It's just tracking the actual cost, and we don't have really a way to do that currently. But if you were the one who owned the diamonds, of course, you'd be tracking the cost of each one anyway. And the same thing with automobiles or RVs. But anyway, in this chapter, there's a couple of things we are not going to cover. And one is we're not going to do lower cost or market in this course or inventory areas. We're saving those for the intermediate accounting class. And then we are in that same section, those pages 315 to 316 and 322 to 323, near those pages, there are some things that I want you to look at. And one is the effect of choosing one of the four methods over the other. And so the impact it has on net income. And also, I do want you to look at the index, at the appendix 7A, which is the top of page 330 down to 322, which is in the middle of some of those areas we're skipping. But I do need you to look at that appendix because we're not skipping that piece. So what we're going to do is we're going to try to get to where we can understand the inventory calcs. And there's two ways that you can calculate inventory, on the periodic method or on the perpetual method. On periodic, what this one is doing is it's just waiting until the end of the period and then looking at what's still in the inventory, taking a physical count, and everything else that's not in the physical count would be counted as cost of goods sold. And so that's the periodic way. Perpetual, instead of looking at it at the end of the period, would create an entry every time there was a sales transaction that would allocate the cost at that time. So you could do periodic based on FIFO, LIFO. I'm sorry, my acronyms for first in, first out are FIFO. Acronym for last in, first out is LIFO. So we could use any of these methods, FIFO, LIFO, or average, with the periodic method or with the perpetual method. So mostly we'll be focusing on perpetual because that's what the real world uses, but there is some benefit to understanding the periodic as well. All right, so let's work some of these exercises from the Openstax book. This first one, EA1, is telling us that we're going to calculate the goods available for sale for Atlantis Company in units and in dollar amounts, given the following facts about their inventory for the period. Now, if you remember, we talked about this goods available for sale already. It's a very important concept. And basically, there's two ways to arrive at goods available for sale. First, you could say, how much inventory do we have at the beginning of the period, plus how much inventory did we add this period? And when you add those two things together, the beginning inventory plus the purchases this period, you have the amount that's available for sale. So the goods available is the total of the beginning inventory and the purchases this period. So that's one way to come up with it. But if you didn't have those numbers, somehow some of the pieces were missing in your records, you could come up with how much goods available are by looking at what is the cost of goods sold this period and what is the ending inventory. Because goods available is the summary of beginning plus purchases. But that because of the nature of goods available is just, here's all I have that I can sell. I cannot sell more than this because this is the limit of my inventory. So goods available is just the total amount you had that you could have sold. So the reason that's important to know is that because if you know how much you sold and you know how much you have left, you could also just add those two numbers together, and that would tell you how much had been available to sell. So in this one, though, we're going to take the top approach, which is the beginning plus purchases. And so this one, they give you the number of units and the cost per unit for beginning inventory, and then some purchase, then they tell you they sold some, and then a purchase again. But so if we're going to only calculate what is goods available, we don't actually need to know about the sale at this point. We could use this to see how much the cost of that sale is. We could use FIFO, LIFO methods to calculate. But in this case, they're just asking us for the goods available. So we're just going to multiply the number of units times the cost to see how much was the beginning inventory. And then it was just 140 units times 75 brought us to this 10,500. And then how much was purchased? So the amount that was purchased is this 240 units at 77 and 220 units at 80. So what they've done is just they added together the calculations of those two. If you take 240 times 77, you're going to come up to, I did it, 18,480. Put that right over here in parentheses, I guess. Well, not right over here. Okay, I'll just put it under it. 18,480 is what I got when I multiplied the 240 units times the 77. And so 18,480 plus the total of 220 times 80, which is 17,600. When you add those two together, you come up with this 36,080. That's where that one's coming from. And so if you know how much the beginning was, it's 10,500. And you know how much the purchases cost, 36,080, then that means you know what goods available are. So 46,580 is the goods available. If you look at it from the standpoint of numbers of units, you have the beginning inventory at 140, and then you purchased two lots, one lot of 240 and one lot of 220 for a total of 460. So you have 600 units available total, the beginning inventory of 140, and then the purchases inventory of 460. Okay. I'm going to delete this now, since we've shown how it works. EB1. This one says calculate the goods available, the same thing. So if you want to practice what we just did, just pause the video and calculate it. And then whenever you unpause, you're going to see me solving it. All right, so the same process that we just did, the goods available is the total of the beginning inventory and the purchases. So beginning inventory was this 1,100 units. And then you see that we purchased two lots, 800 right there and 650. So that's where this 1,450 is coming from right here, from the total of 800 and 650. So we have a total number of units of 2,550. And in order to find the cost of each of those, you just multiply them by the cost per unit. So 1,100 times $20 means we had 22,000 of beginning inventory costs. And then the purchases would be 800 times 20, which is 16,000. And then 650 times 21, which is 13,650. If you add 16,000 and 13,650, you're going to come up to this 29,650 for the purchases, and add the beginning inventory to that, and you get the total goods available for sale, 51,650. So again, to find the amount of goods that are available that you can sell, it's just a simple matter of how much inventory did I have at the beginning of the period when I walked into this period, how many were sitting here in my storehouse, and then or in my storefront that I'm ready to sell. And then the addition is how much did I buy? How many units at what price? And so that's where the 29,650 is coming in. That's the purchases. So when you add them together, you get goods available for sale. Okay. Now the next one is EB6. They're showing you the companies. They have one little problem here. This is not per unit. This heading they have, cost per unit, should say total cost, because that 30,800 is for all of the units. So what they're doing is they're asking us to calculate the gross margin for the period for each of the following costs. Let's see if I can get this to Xer. I don't think I can because it's a picture. Okay. I'm just going to add a little information here. The beginning, 880. Unit cost, rather than being 30,800, if you divide 30,800 by 880, you get $35 per unit. The June 1st purchase, 750 units, and $30,000 for 750 units means they cost $40 a piece. And then the November 1st purchase is 800, which we paid $34,400 for. If you divide it out, $34,400 divided by 800, you get $43 per unit. I've already multiplied those out or divided those out. Okay. So far, we got one piece we needed. We needed to know how much the per unit cost is for each of the levels. And then the other thing that we needed to know is how many did we sell the total goods that were available, they told you how many units were available, and they told you how many were in ending inventory. So that means you can see how many you sold. Units sold equals 2430 minus 110. I'll get rid of the equals over there. So I think the units sold is 2320. Okay. All right, so that's some of the information we need. We could also do an average cost by this data that they gave us. You see this, they've given us the total cost per unit for all the beginning plus the purchases. So the average, also known as the weighted average cost could be calculated by that little table they gave us. 95.2 divided by 2430. That was all the units that were available. And I did that and I came up with $39.18. Okay. And that's just coming from this table, 95, the total cost of 95.2 divided by the total number of units that included, and that gives us our average cost. Okay, so that's the basis of what we're going to use to solve these problems that are coming up. We're going to calculate the gross margin for the period for each of the following cost allocation methods: gross margin, gross profit, interchangeable, using the periodic inventory updating. So basically, we're just going to count it at the end of the period rather than looking at it on a perpetual basis of, well, we sold this one, what date did we sell it? We don't have all that because this is just a periodic calculation of the inventory. We'll do some perpetual calculations of inventory under these methods in a minute, but this is just our start place. Okay. All right. So the periodic method for first in, first out, then the periodic method for last in, first out, then the periodic method for average, weighted average. Okay, so what we're going to do, I'm going to just make this or reveal this format of what we're going to do to figure it out. We're going to take the ending inventory. We're going to first come up with the ending inventory. And so the ending inventory is 110 units, right? We know that because they gave it to us in this data set. So in all cases, we have 110 units. So this line, we're just going to use to put our 110. We're trying to get gross margin or gross profit. So they did the average right here rather than, yeah, that's not what I'm going to get rid of that for a moment. Okay, 110. Each of them is 110, but what is the cost under the different assumptions of how the cost flowed? So when you look at the periodic method, you just look at what's left to determine the ending inventory. So for FIFO, first in, first out would mean when you sold these goods, you sold the earliest ones first. So the ending inventory would be the most recent purchases that you made. So for FIFO, your ending inventory is going to be this $43 per unit because you bought 800 units right there. So the last ones you bought was 800 units, which covers all of the ones that are left. So all of this 110 units were bought in this last purchase. So if you sold them first in, first out, you would have sold all of the beginning inventory of 880 units, all of the 750 units, and you would have sold 690 of these November 1st units, and you'd be left with just 110 of the $43 units. So that's what this is going to do. We're going to multiply 110 times 43. And that's how we're going to get this. 110 at 43. Right? Okay. Now, to get the ending inventory for LIFO, we do the opposite. We look at it, we say, if we work on LIFO, it means we sell the last ones first. We assume we sold them first. So the thing that would remain at the end of the period would be some of the beginning inventory would still be there. So the beginning inventory, as you remember, we calculated the per unit for the beginning to be $35 per. So under LIFO, the ending inventory would be some of that beginning inventory. It would still be some that were bought the earliest time period at $35. So 110 units at 35 would be 3,850 under LIFO. You see, because what we're saying is when you use first in, first out, you would sell all the earliest ones and you'd be left with the latest purchases. So this $43 units would be what was left in inventory if you were using the first in, first out method. But if you were using the last in, first out method, assuming you were selling the last ones first, then the ones that would remain in ending inventory would be these early purchases, the beginning inventory, $35. So that's why the beginning inventory under LIFO is the $35 units. And then the average is just what it sounds like. I'm going to copy this format down so I can show the ending inventory under the other method. And I'm going to change the amount. Remember, I calculated the average to be $39.18. Right up here. Average units sold. Average cost is 95, not the average units sold. I'm sorry, the average cost was 95.2 total. They gave it to us, and 2,430 units. So when you divide that out, each unit had a cost of an average cost of $39.18. So 110 units under the average method would be 4,309. Okay. So now the next one. Sorry, my pencil is breaking. All right, I got it. Okay, so the next thing we do is we have to see how much is the sales. The information said all the units we sold were sold for $50 each. And how many did we sell? We already know that. 2,320, right? So sales, the sales figure is 2,320 times the $50, right? I calculated that, and I think it is 116,000. You can use your calculator and double check that for me. That'd be awesome. 116 is the sales number, no matter which method we're using. Because that's what this is all about. The different, showing you what the different methods do to the sales. Nothing. They do nothing to the sales, because when you record the sale, it is for whatever you sold it for. It's just which method are you going to use and how is it going to affect the cost you're attributing to that sale. So if you use the first in, first out method, you're going to say that the total cost of goods sold is the goods available for sale, which we already calculated to be, or they already gave it to us, 95,200. So I can just drop that in there. Goods available for sale is 95.2. And ending inventory, we calculated already at 4,730 for FIFO. So that means our cost of goods sold, we can calculate, we can easily come up with, because it's just the total goods that were available minus the ending inventory. Because remember, if you want to know goods available, you take beginning plus purchases. So that goods available number is also the combination of the ending inventory and the cost of goods sold. That's because when you have these goods that are available, one of two things happen to them. You either still have them, so they're in your ending inventory, or you sold them, so they're in your cost of goods sold. So the combination of cost of goods sold and ending inventory brings you back to that goods available. So we have goods available. We know the amount of goods available because we know the amount of cost of goods sold because we knew goods available amounts and we knew ending inventory amounts. All right, so let's do it for the LIFO. Last in, first out method, the sales numbers didn't change and the goods available number doesn't change. It's just that the ending inventory is telling us a different number. So we know that the cost of goods sold is a different number. The total goods available minus whatever the ending inventory. So under LIFO, the ending inventory was 3,850. So that left 91,350 as our cost of goods sold. Then under the average method, we have still the same goods available for sale. And an ending inventory is 4,309. So we can calculate from that 95.2 minus 4309 gives us the remaining amount that has to be the cost of goods sold. If it's not in the ending inventory, that means we sold it. So now we have sales and cost of goods sold. That means we can come up with gross margin, AKA gross profit. At 116 minus 90,700 means the gross profit or gross margin is 25,530 for FIFO. And then for LIFO, 116 minus 91,350 gives us a gross profit of 24,650. And then under the average method, 116 minus 90,891 brings us to a gross margin or gross profit of 25,109 under the average method. So you see that all came out a little bit different. So the bottom line profit is, in this case, it was highest. Most profit was shown using the first in, first out method. So that's not complicated. It's just a lot of steps. So just once you get used to the steps, you'll be fine, but it just takes a little time to get through them. So I'm going to put a page break here to get me onto a new page. All right, the next one we'll do PA5. Now this one says use the first in, first out method, just one method, and with perpetual inventory updating to calculate sales revenue, cost of goods sold, and gross margin or gross profit for this A75 company. Consider these transactions. So it has beginning inventory, it has one purchase, and it has sales. So the sales, you had 88 units at $75. So that's easy enough to come up with the sales amount. 88 times 75 means we sold $6,600 worth of goods. So we'd make that journal entry that debits cash or accounts receivable and it credits the sales revenue for $6,060. Then we want to know, we're about to make that twin entry that debits cost of goods sold and credits the inventory account, but we're trying to figure out how much to put in that entry. So that's why we're trying to figure out which ones would we assume we sold if we're using the first in, first out method. We have two lots of product. One lot, 105 units, we bought at $40 per. And then at the second lot on March 2nd, we bought 150 more units for $42 per. So if we're selling first in, first out, that means we have to assume we're selling the first units we bought first. So the beginning inventory units, 105 units at 40 is what we're assuming we're selling from. So we're selling the cost 88 units at $40. That's what's going to be our cost of goods sold, because first in, first out says you assume you sold the ones that were acquired earliest. So once you know sales and cost of goods sold, that makes gross profit or gross margin very clear. Just sales minus the cost of goods sold brings you to the gross profit, 3,080. Okay, now we got another one like it. I want you to pause it if you would and work this problem and see if you are getting the concept. This one is, instead of first in, first out, it's last in, first out. So it works exactly the same. It's even the same number set. It's just what would the result be if you used LIFO instead? So give it a shot. All right, so the sales under this would be exactly the same as they had been under FIFO because that's not what's in question here. The sales, again, we'd make that sales entry with a debit to cash or accounts receivable, and depending on which they did, if they paid us or not, and a credit to sales revenue. Then we would look for what are we going to make in this cost entry. We know we're going to debit cost of goods sold and credit the inventory, but how much should we allocate for the cost of these goods? So if it's last in, first out, we have these two sets of goods or two lots of product. So assuming last in, first out, we're going to assume we sold from the $42 units because they were the last we bought. And that means we take 88 units times 42 to come up with 3,696. Then for gross margin, we just take sales minus cost of goods sold for 2,904. So comparing the two methods, it looks like that first in, first out produced a gross margin of 3,080 and last in, first out produced a 2,904 margin or profit. So the key is on this, in a period of rising prices, then you get a higher net income or a higher gross profit from first in, first out than you do with last in, first out when the prices are rising. And that's just because when you're using the last in, first out method, you're using the most current purchase as your cost. So that's obviously going to reduce your profits that's showing up on your financial statement if you use a higher price item. Now, if the situation was reversed and prices were falling, it would be the opposite. But for now, most of the time you see rising prices. On rising prices, that means first in, first out shows a higher income because those early cost items are lower. Okay. Now, one more for this exercise group, and this is the weighted average one on the same group. Again, this is perpetual. And so it's using the same scenario that we already did, but it's just looking at how do we decide the cost. So again, you can pause it if you want to do this one. And so I'm just going to solve it now. So what we got is the sales figure is the same, of course. That's not in question. The question is which way are we going to cost it? So for average method, I'm going to calculate the average 105 units times 40 plus 150 units times 42. Those two combined, so I got 4,200 for the beginning inventory, 105 times 40, and then I got 6,300 for the ending inventory. Not the purchase, sorry. And so I add them together and my total inventory is 10,500. So I have how many units? I have 105 plus 150, 255. So I just took my beginning, I calculated based on 105 times 40 to be 4,200 plus purchases. And I multiplied 150 times 42 to get 6,300. So now my goods available for sale winds up being 10,500. If I divide that by the total number of units, 105 plus 150 is 255. That brings me to the same number they got, which is 4118. And it might be off, but just a little bit for rounding, but it's pretty close. So that's my cost figure for average. This one, first in, first out. That one, LIFO. This one, average. And for some reason, it says LIFO right there. It's just wrong. Okay, so when the cost of goods sold is 3,624, that means the gross profit is sales minus cost of goods sold. So you come to a gross profit, a gross profit or gross margin of 2,976. Okay, if there's any issue there, of course, you can email me or post it to the Moodle forum. but going back through these and making sure you understand what's the difference in the different ways we did things. We worked these problems under two different assumptions, the periodic and the perpetual. That's all for this one, and I'll come back and do some exercises from the textbook.